Hi, and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's see the analysis.
Let's look at the tape. Today is Wednesday, February 25th, 2026, and the numbers are frankly undeniable. Circle Internet Group, ticker CRCL, opened this morning at $73.77. That is a massive gap up from the previous close of $61.37. We saw an intraday high reaching over $80, and the volume is absolutely surging, hitting 44.12 million shares today. And if you compare that to where we were just 20 days ago, February 5th, when we hit that value reset low of $49.90, the sentiment shift is palpable. This price action, combined with the Q4 earnings released this morning, signals a definitive pivot in my view. Circle is transitioning from what many thought was a speculative crypto play into foundational internet financial infrastructure. And I represent the view today that Circle has achieved stablecoin escape velocity.
Well, I am looking at the exact same numbers. And sure, a 30% intraday move is impressive theater, but let's not lose our memories here. This stock is coming off a brutal round trip from the high 200s down to 50. That is an 80% drawdown. So while you see a definitive pivot, I see a relief rally. I take the position that this is a temporary bounce for a company heavily reliant on interest rates that are about to be cut. The central question we have to figure out is whether this recovery is a true validation of the internet financial system thesis or just a macro-driven anomaly.
I think framing it as a macro anomaly misses the structural change happening under the hood. When I look at the institutional adoption from players like BlackRock and Vanguard, and the strategic utility being built with Visa and Intuit, I see a moat being dug that is much deeper than just, simple interest rate arbitrage.
And I see a revenue model that is incredibly fragile. You have insiders exiting the building, a massive venture capital exodus, and a competitive landscape shifting toward yield-bearing assets. So I just don't buy that this escape velocity is sustainable if the macro environment turns against them. But let's get into the specifics. You're clearly bullish on the earnings print. Walk me through why you think this is a validation rather than just a lucky peak cycle quarter.
It is not just that they beat, it's how they beat. We are looking at $770.23 million in revenue for the quarter. That is up 76.9% year over year. The consensus was looking for an EPS of roughly $0.16, and Circle delivered $0.43. That is a massive beat. But the number that really matters here, the real takeaway, if you will, is the operating leverage. Adjusted EBITDA for the full year hit $582 million. That's up 104%. This proves that as the network grows, costs do not grow linearly with it. They're capturing more value. The software margin is finally kicking in.
Hold on, let's define that value carefully. That $770 million isn't coming from software license fees.
No, but
90% of that revenue comes from interest on reserves. Circle is essentially a bank that doesn't pay interest to its depositors. They take the user's cash, they buy treasuries, and they keep the yield. And look, that works beautifully when rates are high. But the market fear right now, the dominant narrative, is a Federal Reserve rate cut. If rates go down, that $770 million revenue number develops a massive hole. The operating leverage you are celebrating is levered to the Fed funds rate, not necessarily user adoption.
I disagree that it's solely the Fed. You are completely ignoring the regulatory and technical moats they've built. Beyond the spreadsheet, we have the ARC blockchain, their economic OS, and the conditional OCC National Trust Charter. These aren't just little financial wins. They are structural barriers to entry that separate Circle from any other issuer in the world. Being a regulated trust bank is a very different game than being an offshore stablecoin issuer. That charter is the bridge to the traditional banking system.
It is a bridge that costs a lot of money to maintain, though. And regarding the capitulation context you mentioned earlier, the stock losing nearly 80% of its value, that wasn't an accident. That was the market realizing this exact vulnerability. You call it a value reset low at $49.90. I call it a reality check.
The narrative was that regulation would crush them or that Tether would eat their lunch, and neither of those things happened.
But look at who knows the company best. I am talking about the insiders. This is where your narrative gets very shaky for me. General Catalyst, one of the earliest and most informed backers of Circle, didn't just trim their position. They filed a 13GA showing a 100% decrease.
Right.
They exited a 20 million share position, completely out. Fidelity reduced their holdings by nearly 96%. James Breyer reduced by 48%. These are the people who sat in the board meetings. If the infrastructure thesis is so inevitable, why are the architects of that thesis selling into this pop? To me, that suggests they see this as an exit liquidity opportunity, not a buying opportunity.
That is a fair point on the insider selling, I'll grant you that. But I would frame it very differently. This is a classic rotation of capital, not an abandonment of the company. You are focused on the venture capitalists leaving, which is exactly what VCs do. They exit to return capital to their limited partners. They invested when Circle was a startup. Now it's a public company. The risk profile has changed entirely. But look at who is buying. This is the smart money rotation. ARK Invest, led by Cathie Wood, has been accumulating aggressively. In a single day in early February, ARK bought 175,000 shares. Their total holding is now over 4.14 million shares. That is high conviction during a massive drawdown.
Or it's doubling down on a losing bet. Let's be real here. ARK was buying while facing a 39% paper loss on their initial positions. Cathie Wood is known for averaging down on disruptive tech. But that certainly doesn't always mean she's right about the timing.
But it is not just ARK. That is the key point. Look at the passive giants. Vanguard increased their holdings by 61.6%. BlackRock increased by 31.5%. When you see BlackRock and Vanguard moving in with that kind of size, it signals that CRCL is becoming a standard index holding. It is moving from a speculative venture bet to a core component of the financial technology stack. The VCs are handing the baton to the asset managers. That is a sign of maturity, not weakness. It means volatility should theoretically decrease as the shareholder base stabilizes.
See, I come at it from a completely different angle. When early venture capitalists sell their stakes to passive index funds, that often signals the end of the hyper-growth phase. The alpha, that massive outperformance potential, is gone, and now it is just beta moving with the broader market. You mentioned BlackRock and Vanguard, and yes, they are buying, but they buy everything in the index. That doesn't validate the business model. It just validates the market cap. The VCs, however, are active managers. They are making a specific, conscious choice to leave. And I think they are leaving because they see the competitive reality that you are glossing over.
What competitive reality is that?
The yield problem. This is the elephant in the room. You have competitors popping up offering yield-bearing stablecoins. Why would a sophisticated corporate treasurer hold USDC and let Circle keep the 4% or 5% interests when they could hold a tokenized money market fund or a yield-bearing competitor and keep that interest for themselves? The strategic utility you talk about has to compete with simple math. If Circle keeps all the reserve income, their product becomes expensive to hold compared to the alternatives. And let's not forget, Tether is back in the US market. The moat isn't as wide as you think it is.
I am not convinced by that line of reasoning because it ignores the velocity and integration arguments. Yield is nice, but utility is essential. You can't pay for coffee with a treasury bond, and you can't settle a Visa transaction with a tokenized money market fund instantly. Let's look at the Visa data. USDC transaction share on Visa settlement rails grew from 39% to nearly 50% quarter on quarter. That is massive. That means half of the stablecoin volume on the world's largest payment network is USDC. That isn't about yield, that is about liquidity and trust.
It is impressive volume, I will give you that. But is it profitable volume?
It becomes profitable through the network effect. And it gets even better with the Intuit partnership. This is the definition of the USDC supercycle. By embedding USDC into TurboTax for tax refunds, they are tapping into a $100 billion annual volume opportunity. Imagine getting your tax refund instantly, 24/7, even on a Sunday, because it moves on the ARK blockchain rather than the archaic ACH system. Speaking of which, the ARK blockchain testnet is already processing 2.3 million daily transactions. It is an economic OS, not just a ledger. This utility creates stickiness that a simple yield-bearing token just can't replicate.
The Intuit partnership is a great headline. I agree. Immediate tax refunds are a compelling consumer use case. But let's look at the regulatory side of that mode. You mentioned the OCC charter earlier, but the Clarity for Stablecoins Act is still pending final administration buy-in. While the Genius Act passed, the regulatory framework isn't fully sealed. If that stalls, or if the SEC decides to take a harder line on the economic OS definition, treating it as a security rather than a commodity, that utility could face serious headwinds. And frankly, I worry that the broader market just doesn't know how to value this thing yet.
Well, let's talk about valuation, because that is exactly where the opportunity lies. This confusion is why the alpha exists.
Or the trap.
I view the technicals as having formed a durable bottom. We saw a classic triangle pattern and a bullish RSI divergence right at that 49.90 low. For those who aren't technical analysts, the RSI divergence basically means the selling pressure was exhausting itself even as the price dropped. That was the capitulation. The gap up to $73 today reclaims key moving averages. Needham has a price target of $250. If the infrastructure thesis holds, if Circle really is the Amazon of money, $250 is not unreasonable.
And Wolf Research has a price target of $40 with an underperform rating. That is a massive spread, $40 to $250. That tells me the market is incredibly confused. And here is a number that worries me. If you strip away the stock-based compensation charge, which was a staggering $424 million, the company still reported a net loss of $70 million for the year from continuing operations. So on a GAAP basis, the actual accounting standard, despite all that top-line revenue, they are burning cash. They are acting like a tech firm with massive stock-based comp packages to engineers, but they earn like a bank. That identity crisis is why the valuation is so precarious.
I see why you focus on the GAAP net loss, but that includes one-time items related to the IPO vesting. The adjusted EBITDA of $582 million is the true measure of cash generation here, and that is growing triple digits. You have to look at cash flow, not just accounting profits, when a company is in this specific growth phase.
Adjusted EBITDA is often where companies hide the bodies. It completely excludes the very real cost of paying employees with stock, which dilutes the shareholders you're trying to defend.
But in this case, it shows the operating leverage of the software. Once the code is written, the marginal cost of issuing the next USDC is effectively zero. That is why the margins are expanding. It is a software business model applied to money.
Unless the interest rates drop, we keep coming back to this fundamental issue. You can have the best software in the world, but if your revenue is tied to the Fed funds rate, you are a macro trade. And right now, the macro trade is screaming that rates are coming down. If the Fed cuts by 50 or 75 basis points, Circle's revenue drops instantly, regardless of how many transactions happen on Visa.
But that is precisely why the transaction volume matters. The pivot is from interest income to transaction fees via ARC and merchant settlement. That is the future. As the velocity increases, they can charge for the movement of money, not just the holding of money.
That future isn't here yet. Today, they live and die by the spread. And investors buying today at $73 need to realize they are betting that the transaction fees will ramp up faster than the interest rates fall. That is a timing bet and a very risky one.
I want to push back on the idea that the transaction fee future is so far away. You mentioned the velocity argument earlier, but I don't think we have fully unpacked what the ARC blockchain actually represents in terms of revenue diversification. We aren't just talking about people sending peer-to-peer payments. The ARC blockchain is designed as an economic OS. That means developers are building applications on top of it where USDC is the native fuel. Every time a smart contract executes, every time a programmatic payroll is run, that is a fee event. It is akin to the App Store model. When you have 2.3 million daily transactions on the testnet, that is not just testing. That is an ecosystem warming up its engines.
It's warming up, sure, but let's be realistic about the timeline. Ecosystems take years to mature. The App Store didn't become a massive revenue generator for Apple overnight. My concern is the gap between now and then. We are sitting in 2026. The market is pricing Circle today like that ecosystem is already fully monetized. If there's a lag, if developers are slower to adopt ARC because of the regulatory friction I mentioned, or because they prefer Ethereum Layer 2s or Solana, then you have a stock price for perfection in a world that is very messy. And let's not ignore the Clarity for Stablecoins Act again. You seem confident it will be smooth sailing, but since when is anything in Washington smooth sailing?
If that legislation gets watered down, or if it imposes capital requirements that look more like a traditional bank, Circle's return on equity gets absolutely crushed.
Regulation is a double-edged sword, I will grant you that. It adds friction, but it also clears the board of low-quality competitors. If capital requirements go up, who survives? Circle, because they are the ones with the balance sheet and the audit history. The smaller, yield-bearing competitors you mentioned, the ones operating in the gray areas, they get wiped out. So, in a weird way, stricter regulation actually solidifies Circle's monopoly. It becomes a winner-take-most market. That is why I think the valuation spread we talked about earlier, specifically the Needham $250 target, is looking at the terminal value of a monopoly, not just the next quarter's interest income.
A monopoly is a strong word. You are assuming Tether just disappears, or that the big traditional banks, JP Morgan, Citi, don't just launch their own tokenized deposits that function exactly like USDC, but live on their own private ledgers. That is the nightmare scenario for Circle. Not that crypto fails, but that the banks wake up. If JP Morgan offers a JPM coin that settles instantly and is backed by the fortress balance sheet of JP Morgan, why does anyone need Circle? Circle is an intermediary trying to become a platform. The banks are already the platform.
The banks are walled gardens. That is a critical difference. A JPM coin works great if you are a JPM client moving money to another JPM client. But the internet is open. The internet financial system thesis relies on interoperability. USDC is neutral. It works on Solana, it works on Ethereum, it works on Base. It doesn't care who you bank with. That neutrality is the value proposition. It is the TCP/IP of money, whereas JPM coin is like an internet from the 90s, and the market is voting with its liquidity. That is why the Visa partnership is so critical. Visa isn't partnering with JPM coin for global settlement. They are deepening their integration with USDC.
Neutrality is a nice ideal, but historically, vertical integration wins in finance. But let's pivot back to the stock price for a moment because that is what our listeners are looking at today. We are at $73.77. We gap up. You mentioned the technicals, the RSI divergence, but I look at the volume profile on the way down. There is a lot of overhead supply. There are a lot of people who bought at $100, $150, $200 who have been holding heavy bags for a long time. As this price grinds higher, those people are going to be looking to get out of break-even. That creates a natural ceiling. Do you really think we can chew through all that supply just on the back of one earnings beat?
That is a classic technical analysis concern, the bag holder theory. But I think it ignores the turnover we have already seen. The volume spike today, 44 million shares, tells me that the shareholder base is swapping over. The weak hands who wanted to sell capitulated at $50. That is what a capitulation low is. It is the moment when everyone who is scared finally puked the stock. The people buying now, including the massive passive flows from Vanguard and BlackRock we discussed, aren't looking to sell at $100. They are accumulating for a multi-year hold. The overhead supply is much less thick than you think because the register has been cleaned out.
I admire your optimism. I truly do. But I look at the macro picture and I see storm clouds. We haven't even touched on the geopolitical aspect. The dominance of the dollar is what underpins USDC. If we see a shift in global trade settlement away from the dollar toward baskets of currencies or commodities, then the addressable market for a dollar-backed stablecoin shrinks. Circle is a long bet on the US dollar continuing to be the hegemony of the internet. That is a crowded trade.
It is a crowded trade because it is the winning trade. The demand for dollars in emerging markets is insatiable. In Argentina, in Turkey, and Nigeria, people aren't clamoring for the yuan or a basket of commodities. They want dollars. Circle delivers that digitally. That is a demographic tailwind that no interest rate cut can stop. In fact, if the Fed cuts rates and the dollar weakens slightly, the demand for stablecoins in emerging markets often increases as a hedge against local inflation. So the macro argument actually cuts both ways.
That is a fair point on emerging markets. But Circle makes its money on the reserves held for those tokens. If the user in Nigeria holds USDC, that is great for the volume metric. But if the yield on the backing asset is 2% instead of 5%, Circle makes less money on that Nigerian user. We go in circles,
pun intended, back to the interest rate.
We do, but I think we are just looking at entirely different horizons. You are looking at the next 12 months of Fed policy. I am looking at the next 10 years of internet architecture.
And as an investor, I have to survive the next 12 months to get to the next 10 years.
I suppose that brings us to the crux of the disagreement. We have seen the pivot today. In my view, Circle has successfully executed a transition. The migration of ownership to BlackRock and Vanguard, the securing of the conditional OCC charter, and the 77% revenue growth are the definitive proof points. This isn't just a crypto coin anymore. It is the rails for the next generation of finance. The low we saw at $49 was a generational buying opportunity, and the Amazon of money narrative is really just starting to play out.
And I remain highly skeptical. I think the risks are being masked by historically high interest rates. When you look at the reliance on reserve income, the total exit of key VCs like General Catalyst, and the looming threat of yield-bearing competitors, the current valuation feels dangerous. This could very well be a bull trap before the rates get cut and the revenue reality sets in.
Well, we can agree that the future looks different than the past. We are seeing glimpses of it with the Bermuda initiative to go fully on-chain, and the integration with Polymarkets for prediction markets. These are fully on-chain economies where traditional banking rails simply cannot compete.
They are fascinating examples, I will admit. If the world moves that way, Circle wins, but for now, CRCL's stock price is tied to the whims of the Federal Reserve.
And that is exactly where we find ourselves today. The deep bear structure has broken technically, but the fundamental questions certainly remain.
Exactly. It is a fascinating setup, but investors need to decide if they are buying the infrastructure of the future or the interest rate arbitrage of the present.
A crucial distinction. We will leave it there for today.
If you like this video and want to watch more content like this, don't forget to subscribe. Thanks for watching. See you.